Are you ready to build a financial portfolio that not only secures your future, but continues to grow over time? Whether you're a beginner or someone looking to refine your investment strategy, this video is for you. I'll be sharing expert strategies on how to create a portfolio designed for long-term success. No gimmicks, just solid, time-tested advice. Stick around because by the end of this video, you'll have all the tools you need to start building your path to financial freedom. What is a portfolio and why is it important? First, let's define what a portfolio is and why it's essential for growing your wealth. A portfolio is simply a collection of financial investments. This can include stocks, bonds, mutual funds, real estate, and even alternative investments like cryptocurrencies or art. But why does having a portfolio matter? Simple: diversification. By spreading your investments across different asset classes, you reduce risk and increase the potential for steady returns over time. Understanding risk and your investment goals. Before creating your portfolio, you need to understand two key things: your risk tolerance and investment goals. Risk tolerance. This refers to your ability and willingness to lose some or all of your investment in exchange for greater potential returns. Are you someone who loses sleep over market dips? Or are you willing to ride the ups and downs for potentially bigger gains? Investment goals. Your goals will dictate your investment strategy. Are you saving for retirement in 30 years? Or do you need a down payment for a house in 5 years? Key elements of a strong portfolio. 1. Diversification across asset classes. One of the golden rules of investing is not to put all your eggs in one basket. Diversify your investments across different asset classes, including stocks, higher risk but historically offer higher returns over time. Bonds, lower risk and provide stability to your portfolio. Real estate, great for long-term growth and passive income. Alternative investments, cryptocurrencies, commodities, and even art can add a unique dimension to your portfolio. 2. Asset allocation strategy. Decide what percentage of your portfolio will go into each asset class. This decision is based on your risk tolerance and investment timeline. For instance, a younger investor might have 70% in stocks and 30% in bonds, while someone nearing retirement might flip that ratio. 3. Rebalancing regularly. As market conditions change, your portfolio may become unbalanced. Let's say stocks perform exceptionally well. Your initial 70-30 allocation might become 80-20. To maintain your desired risk level, you need to rebalance. Rebalancing simply means selling some assets and buying others to get back to your target allocation. Investment strategies for long-term success. 1. Dollar cost averaging, DCA. This is a strategy where you invest a fixed amount of money at regular intervals, regardless of market conditions. It helps reduce the impact of market volatility. Example: if you have $1,000 to invest, rather than putting it all in at once, invest $100 per month for 10 months. 2. Growth versus value investing. Growth investing focuses on companies that are expected to grow faster than the market average, such as tech stocks. Value investing involves buying stocks that are undervalued compared to their peers. A balanced portfolio often includes a mix of both growth and value stocks. 3. Dividend investing. Invest in companies that pay regular dividends. These payouts can provide a steady income stream and can be reinvested to accelerate portfolio growth. 4. Index fund investing. Index funds are a great way to invest in the market as a whole with lower fees and less risk. Warren Buffett himself has recommended them for most investors. Avoiding common mistakes. 1. Emotional investing. One of the quickest ways to derail your portfolio is by letting emotions dictate your decisions. Markets will go up and down. Don't panic and sell during downturns. 2. Chasing trends. Be cautious about jumping into the latest investment fad. Just because everyone is talking about it doesn't mean it's a sound investment. 3. Ignoring fees. High management fees can eat into your returns over time. Look for low-cost index funds and be mindful of transaction fees. 4. Failing to research. Do your homework. Understand what you're investing in and why. Blindly following someone else's advice can lead to poor outcomes. Building a portfolio step by step. Step 1. Set your investment goals. Clearly define your financial goals, whether it's retirement, buying a home, or funding your child's education. Step 2. Determine your risk tolerance. Use online risk assessment tools or consult a financial advisor to gauge your comfort level with different types of investments. Step 3. Choose the right investment accounts. Depending on your goals, you might need a 401k, IRA, brokerage account, or even a robo-advisor. Step 4. Select your investments. Pick a mix of stocks, bonds, real estate, and other assets that align with your goals and risk tolerance. Step 5. Monitor and adjust. Review your portfolio at least once a year. Make adjustments as needed to stay on track with your goals. Success stories to inspire you. Let's look at a few inspiring examples of people who successfully built wealth through a well-crafted portfolio. Lisa started investing in index funds in her early 20s with just $100 a month. Today, she's in her late 30s and has a six-figure portfolio, providing her with financial security. Then there's John, who focused on dividend stocks and now enjoys a steady passive income stream in retirement. Building a portfolio that grows your wealth isn't just for Wall Street experts, it's for anyone willing to start and stay consistent. Remember, the best time to start investing was yesterday. The next best time is today. Thanks for watching, and I'll see you in the next video.